Welcome back. Take a look at futures this morning. We are looking at more selling pressure this morning. The Dow Industrial's down 103 and the Nasdaq down 43 right now. The market's extending yesterday's sell-off after the Dow closed down better than 400 points yesterday after the hotter than expected consumer price index decreased hopes that the Federal Reserve will cut interest rates as soon as this June. Now, the March producer price index is out this morning at 8:30 a.m. Eastern. The economists' expectations call for a gain of 0.3% month over month and a gain of 2.25% year over year. Joining me right now to get ahead of it is Portfolio Wealth Advisors President and Chief Investment Officer Lee Munson. Lee, good to see you. Thanks so much for being here this morning. I want to get your reaction to the CPI and the reaction yesterday and what you might expect today for the PPI.
Well, I think everything is going to be hot. This isn't a surprise. My biggest fear has been inflation getting higher. I don't think the Fed hiked as much as they should have last year, even though we all complained about it. But the market has been telling us this. If you look at the price of energy stocks, from January, they're up 20%. You look at the price of gold in the last month, it's up huge. And the reason that is those markets are predicting that, when you have GDP at almost 6%, when you have the 10-year rising 15% in yield this year, almost in a straight, nice little linear line, what we're saying is that the Fed policies aren't working right now. So it never made sense to me that we're just going to buy tech on rate cuts. The Fed said they're going to be slow. I think they're going to cut, but I think it's going to be much later this year. This is what's going to cause a correction this year. It's not going to be election problems. It's not going to be the fear of November. It's going to be the fear of inflation, and I'm waiting for that reaction. I think it's starting right now.
Well, what do you want to do as an investor? I mean, you mentioned gold. Of course, this is a place for investors to hide in the midst of pressure and unknown in the stock market. But is this a place, do you think, for long-term holdings? Gold this morning is up again, sitting at 2,352. You want to own gold here?
No, I want to sell gold here. I don't own any right now. I have a few clients that own it. Gold is predicting what's going to happen, but where's the follow through? Where's the cash flows? I'd rather, if you own gold right now, I'd say take some profits and go buy some energy stocks, go buy some bank stocks. Your major bank stocks are up more than the Nasdaq this year. They're doing very well. Energy banks, they're doing better than Apple. They're doing better than Microsoft. That's going to be something that, we're going to rotate in through this summer. It's going to take a while for the Nasdaq to get its mojo back. Nobody wants to buy AI stocks right now because you have mega scalers like Microsoft and Facebook. They want to see a profit before they sink billions and billions and billions of even more money. Yeah. And I think other corporations are looking at that. So I think this is sort of a classic rotation back to value for a few months. I think that's where you want to be. I think that's because, when you've got GDP almost 6%, yep, we're not dealing with a low growth, low rate, cheap money environment.
Wait, 6% is what? How do you get to 6%?
Well, if you look at GDP, if this keeps inflating this way, we're going to start seeing those numbers. And here's the thing. Do I think that we're really going to get there? Probably not, because when you see inflation this much, we're going to start seeing cracks in unemployment. Here's the problem. Yeah. This is the first cycle that I've lived through where unemployment hasn't been this persistent issue and housing prices haven't been this persistent issue. So what's making pros like myself, it's just a little bit different this time, is we can't seem to get that unemployment ticking up. And because of that, the classic cycles and the classic playbook, they're not working quite well this year.
Well, Mark Tepper, jump in here, because I don't even understand this reaction yesterday with a 400-point sell-off. We all knew that inflation was elevated. We all knew that oil prices were above $85 a barrel. Yeah. And suddenly we get surprised when the CPI is elevated.
Yeah. So, look, and Lee, I want to talk a little bit about where oil's been going, because you mentioned inflation has been it's going to be a focal point for investors as we kind of get through the year. WTI right now is at $86 a barrel. Gasoline prices since Biden took office up over 50%. And I'm wondering, my take is that once you have WTI at or above $90 a barrel, it starts to become problematic. That's where you see consumer discretionary stocks begin to underperform. So I'd love to get your take on where oil and gasoline prices are heading.
Well, I think $85 a barrel is a problem in and of itself. And I totally agree. Why were we surprised that hot prints and CPI? I've been talking about hot prints all year being the issue. And the other thing is, because this economy isn't really slowing down that much, why would energy be going down? With all, and let's go back to AI for a second. The amount of electricity, the amount of more energy use that we're going to need to run all this new stuff is going to be beyond what I think a lot of people understand. And it's not just oil. Oil, I think, goes higher It's always hard to predict oil. But if you listen to people who run utilities, they're in the press talking over the last month or two saying we have vastly underestimated how much electricity usage that we're seeing this year. And you know what it is? It's all those server farms. We've created this little disaster, and now we're going to have to pay for it with higher energy prices, which is going to be a tax on the consumer. And again, I'm kind of waiting for the unemployment numbers to tick up. I think that's going to be the next shoe to drop. But I think that really, if you want to be an investor, have a little diversification, sell your gold, buy stocks that actually make money, make cash flows. And you know what? If you love the AI stocks, hey, we all do.
Yeah.
Just take a pause. You might get a sale soon.
Let's get into earnings. The first quarter reporting season begins tomorrow with the major banks. What kind of an earnings season are you expecting? Is inflation going to be an issue there, cutting into margins?
Well, I think it will. I mean, the banks have made, the big banks have made a big step in the right direction in terms of their price action, but that's because of cost cutting. So here's what I want to hear. If all our big banks, Bank of America, Wells Fargo, Citibank, JP Morgan, those type of things, if they continue on their tune of cost cutting, and that's their little thing, actually, that's not really negative for me. But if we start talking about inflation starting eating away, I think that could snowball. And I think you can hear a lot of executives, a lot of CEOs talking about this on why we see weakness. But, honestly, I'm not expecting a horrible earnings season here. But I think sentiment is really going to get beat up. And I think that the consumer and thus the investor is going to think twice about committing capital. I think we could see a buyer strike easily.
Buyer strike equals sell-off in stocks?
Yes.
Yeah, okay. How significantly would you expect? Worse than yesterday?
Oh, yeah. I mean, I think that we could see, we haven't seen many down 3% days at all this year.
Okay.
I think that we could see the S&P crack 5,000. I would be buying everything at 4,800, even at 49,999.
So it's a buy on the dip situation. Lee, it's good to see you. Thank you, sir. Lee Munson joining us this morning on Markets. Your morning mover this morning is rent.